Everywhere you look, the internet screams, "Get rich quick." Even Warren Buffett, the world's greatest investor, has warned against this mindset. The one rule you must never break, because breaking it will cost you everything. Markets crash, stocks tumble, crypto collapses overnight. Would you risk your rent money on a bet? The rule is simple. Never invest money you can't afford to lose. There's a difference between the money that pays your bills and the money that builds your wealth. Your bank account keeps you alive. Your investments should make you grow. That's why every smart investor starts with a simple pie: expenses, savings, then investing. First, build an emergency fund, 3 to 6 months of living costs. Here's reality. 56% of Americans don't even have $1,000 in savings. That means more than half the population is one accident away from financial disaster. In 2008, the housing bubble burst. The S&P 500 fell 57% in just over a year. Families lost homes, jobs disappeared, and those without a safety net were wiped out. History doesn't repeat perfectly, but it often rhymes. Fast forward to crypto. Bitcoin hit 69,000, then crashed to 20. A 70% wipeout in less than a year. Some investors lost everything because they bet the money they needed to live. But those who kept cash reserves, they survived and could buy more at the bottom. In investing, survival is victory. Break the rule, and wealth is destroyed. Neuroscience explains why this rule matters. Your brain feels the pain of losses twice as strongly as the joy of gains. Kahneman called it loss aversion. When prices fall, panic hijacks your brain. When prices rise, dopamine spikes, just like a gambler pulling a slot machine. The amygdala, your fear center, lights up when money vanishes. That's why investing rent money is toxic. It hijacks your survival brain. On scans, gamblers and panicked investors look the same. So ask yourself, are you investing or gambling? Because every loss feels like real pain, not just numbers on a screen. The antidote is discipline. It calms the brain, and discipline is what builds wealth. So how do you apply the rule with a simple framework? Step 1. Build an emergency fund. Step 2. Pay off high-interest debt. Step 3. Invest with a long-term horizon, because credit card debt charges 20%. While the S&P returns about 10 to 12%. Paying off debt is a guaranteed return. Only invest spare cash, money you won't need in a crisis, and think in years, not weeks. Investor A risked his rent in 2008 and lost everything. Investor B used only spare cash, held on through the crash, and came out wealthier. Same market, 2 different outcomes. One destroyed, one disciplined. As Warren Buffett puts it, rule number 1, never lose money. Rule number 2, never forget rule number 1. Protect your downside, and the upside takes care of itself. In investing, discipline always beats excitement. Compounding starts slow, then accelerates like a rocket. Invest just $500 a month. In 30 years, that grows into nearly $1 million. One future, retiring free with your portfolio, or still working at 70 just to survive. So which future are you building today? The disciplined investor sips their coffee calmly because their future is secure. Never invest money you can't afford to lose. Build wealth, not risk.